Hello everyone, welcome to Quantum Advisory's channel. My name is Mulenga Salome Sata and I am the project manager and video presenter for Quantum Advisory Group. Today we'll be unpacking the financial story behind Chilanga Cement PLC and whether they're a good investment or not for a retired investor. Before we get into it, I want to make a quick disclaimer. This is a student project by Quantum Advisory Group for Dr. Byrne Kaulu's Financial Statement Analysis course at the University of Zambia. The content presented is for academic purposes only and is not actual financial advice. To start off the presentation, I'll briefly dive into the background of Chilanga Cement, who they are and what they do. Then I'll look at the accounting standards that they use with their financial statements, and then I'll look at the common size statement analysis. There we will analyze the common size income statement and the common size statement of financial position. Moving on, we shall analyze some ratios and look at their graphical representations. After that, we shall look at the earnings quality, the quality of their incomes and their adjusted income. And lastly, after reviewing all of this information, we will make a recommendation as Quantum Advisory Group on whether the retired investor should invest in Chilanga Cement or not. So, introduction. Who is Chilanga Cement? What do they do? Chilanga Cement is primarily a cement company that was established in 1949. It currently has two plants in operation. The Chilanga plant in Lusaka that was opened in 1951 and the Ndola plant that was opened in 1969. In 1994, it was privatized and became the first company to be listed on the Lusaka Stock Exchange, and CDC was a major shareholder. In 2001, CDC formed PAC, the Pan-African Cement, which Chilanga Cement PLC was a part of. In the same year, Lafarge acquired PAC from CDC. In 2007, Chilanga Cement changed its name to Lafarge Cement Zambia PLC. And in 2008, a new plant was commissioned in Chilanga, doubling the company's cement capacity. Fast forward to 2021, the majority shareholders of Lafarge Zambia PLC sold 75% shares in the company to Huaxin Investment Company. And in December of that year, they decided to change the name back to Chilanga Cement PLC to maintain the reputable legacy and quality of goods and services that had been built over the years. Accounting standard identification. Chilanga Cement prepares its financial statements under international financial reporting standards. Its annual reports explicitly state that their basis of preparation is for IFRS, and this is a requirement by all Zambian Stock Exchange listed companies. What are the implications of using the IFRS? Well, that means that Chilanga Cement only recognizes revenue once performance obligations are met. Furthermore, because the IFRS is a principle-based framework rather than a rule-based framework, it demands clear judgment calls and disclosures. Furthermore, asset revaluation options keep property, plant, and equipment values aligned with market levels, meaning that property, plant, and equipment are valued at their fair value. In addition to that, inventory is not valued using LIFO, but rather FIFO, or the weighted average costing shapes and which shapes costs and margins and working capital. Now, on to the common size statement analysis. These are the consolidated financial statements of Chilanga Cement, but for easier analysis, we crew. But for these are Chilanga Cement's financial statements that were extracted from their annual reports. However, for easier analysis of the financial statements as a whole, we prepared their common size financial statements. We will start with the common size income statement. So, what is the common size income statement? The common size income statement expresses every value or every line in the income statement as a percentage of revenue. And so, as we can see, the cost of sales spiked in 2022 and then eased in 2023, reflecting input price pressures followed by regained vendor leverage. Selling and distribution expenses jumped in 2023, driven by higher logistical costs, and operating profits climbed from 20% to nearly 32% of revenue, thanks to tighter cost control on administration expenses and marketing expenses, and one-off gains, and due to one-off gains such as other gains and losses that haven't been specified. The common size state of financial position. Rose to 39%, led by bigger inventories and receivables, tightening working capital demands. Cash balances swung widely, driven by capital expenditure cycles, stock blocks, or dividend payments, and retained earnings fell as dividends outpaced profits, constraining internal reinvestment capacity. Furthermore, working capital and related party payables that were treated as debt boosted reported leverage and strained liquidity metrics. And finally, deferred revenues and tax liabilities grew, signaling future performance obligations and non-cash equity increases. Now, to further understand their financial statements, the quality of their cash flows and their earning quality, we'll look at the ratio, we'll look at some ratios, and look at their graphical representations. So, the first ratio we shall look at is the free cash flow to firm. What does the real cash flow to firm show? It shows real cash available for dividends, debt paydown, or reinvestment. As we can see on the cluster chart, FFC swung from 384 million, almost 385 million into 2021 to less than 48 million, to negative 48 million in 2022, and then back to 436 million in 2023. That 2022 dip came from heavy capital expenditure and working capital drag. The rebound in 2023 is great, but it highlights sensitivity to capital expenditure cycles and payables. Next, we shall look at the current, quick, and cash ratios, or the liquidity ratios. The current and quick ratios stayed above 2x, confirming that Chilanga can meet its short-term bills comfortably. The cash ratio topped 1x in 2022 and 2023, yet cash as a percentage of assets plunged from 15% to just 3%. That means that while coverage looks strong, absolute reserves have thinned, adding volatility to potential dividend funding. Operating cash flow margin versus net profit margin. The operating cash flow margin shows how much revenue turns into real cash for working capital and dividends, and the net profit margin reflects total profitability but includes non-cash items like depreciation. In 2021 and 2023, the operating cash flow margin exceeded net profit margin, signaling strong cash-backed earnings. In 2022, the net profit margin outpaced the operating cash flow margin, indicating earnings were tied up in receivables or inventory. A sustained operating cash flow above net profit relationship boosts confidence in dividend sustainability. And that is what we have observed in 2023. After the dip in 2022, operating cash flow margin rose again to 29.9. Now we'll look at the free operating cash flow to debt. So the free operating cash flow, or free cash flow to firm, is the amount by which business operating cash flow exceeds its working capital needs and expenditure on fixed assets. As noted in their annual reports, Chilanga Cement has no formal debt and treats trade payables, other payables, and related party payables as quasi-debt. Their coverage was below 1x all years, indicating insufficient cash to repay these payables. And in 2023 and in 2022, which recorded their lowest value of free operating cash flow to debt, marks peak supply reliance and risk. In 2023, they rebound to 0.9x, which indicates an improvement but is still under a safe threshold. Ongoing payables dependence exposes margin dividend. The cash conversion cycle measures the average number of days between paying for raw materials and collecting cash from customers. The cash conversion cycle rose dramatically from 32 days in 2021 to 144 days in 2023, meaning that cash was trapped in inventory and receivables, or Chilanga Cement was paying their suppliers much faster than they were receiving payments from their consumers. A longer CCC shrinks free cash, putting dividend consistency at risk, and a sustained high CCC heightens liquidity pressure and may force reserve draws or delay distribution of dividends. Now, our fixed asset versus asset turnover ratio. Our fixed asset or asset turnover ratios will give a snapshot of the efficiency of Chilanga Cement. The asset turnover fell from 0.97 to 0.65 by 2023, signaling lower revenue per 1 quarter of asset and possible overcapacity. Fixed asset turnover dropped to 0.98 in 2022 before rebounding to 1.02 in 2023, showing slight property, plant, and equipment utilization improvements. Persistently low turnover pressures returns on assets and return on equity. It's underutilization of assets and shows inefficiency in how Chilanga Cement is using its assets to generate revenue that can be translated into dividend payments. And now, interest coverage. Interest coverage measures how many times operating earnings can cover interest expenses. Chilanga Cement's interest coverage remains sky high, well above the 3 to 5x comfort zone, as indicated by most experts. And even after a mid-cycle dip in 2022, where it dropped to 73.52 from 158.79, it still ensures that its earnings before interest and tax easily covers its financing costs. This strong cushion supports dividend reliability and potential for prudent borrowing. Now, debt to equity. Debt to equity ratio measures the proportion of debt financing relative to shareholders' equity. Chilanga's debt to equity ratio remains far above the industry each year. The industry in 2021 was 1.41, and Chilanga Cement's debt to equity ratio was 0.36. This was most likely due to the fact that Chilanga Cement has no bank or formal or traditional debt, and it has continued to be so, even though in 2023 its debt to equity ratio has risen from 2021 to 2022 and then recovered to 19.1% in 2023. The 2022 drop suggests margin or equity-based pressures. And a near 20% ROE supports strong equity returns, but volatility merits monitoring. earnings quality. Here we'll be comparing our net income versus their operating cash flow and their reported earnings versus their adjusted earnings. In 2021, Chilanga Cement had a strong start. Their net income was 291 million and was complemented by operating cash flow of 406 million, yielding a 1.4 cash conversion ratio. A cash conversion above 1x indicates tight control over receivables, inventory, and payables. This robust liquidity position set the stage for funding dividends and capital expenditure without external financing. And in 2022, that's where things went sour. This was the year of contradiction. Net income grew 13% to 329 million, yet operating cash flow plunged 34% to 267 million, driving cash conversion down to only 0.81 or 81%. The likely drivers were a surge in receivables, build-up of slow-moving inventory, and faster payouts to suppliers. Working capital drag created liquidity strain and exposed a gap between on-paper profit and actual cash. And in 2023, Chilanga Cement made a powerful recovery. Net income jumped 36% to 447 million, while operating cash flow soared 126% to 606 million, lifting cash conversion to 1.35 or 135. Our recommendation as Quantum Advisory Group for the retired investor would be to hold before investing. Chilanga Cement boasts strong liquidity and solvency ratios, such as current ratios that were all above 2x throughout the 3 years, quick ratios that were all above 1x, and a cash ratio that rose to 1.15 and only dropped by 0.5 unit points. But actual cash assets fell from 14.9% in 2022 to 3.2% in 2023, which poses a risk for dividend payouts. Debt to equity, which was 0.2, and interest coverage that fell from 158.8 to 87.1 indicates minimal financing pressures. Despite these liquidity cushions and minimal bank debt, it still faces volatile cash flows, free cash flows, stretched working capital, and an extended cash conversion cycle that threaten consistent funding. For a retiree seeking stable and predictable income, we would recommend holding off on this investment until we see sustained improvements in cash flow dynamics, tighter working capital cycles, and more consistent cash buffers relative to assets. In the meantime, we would advise monitoring quarterly cash flow statements and dividend announcements closely. Thank you very much for listening to our presentation.